I see a lot of people lately making mistakes in the stock market. And when it comes to investing in the stock market, oftentimes it's not about what you do right, but it's also about what you avoid doing wrong. And those mistakes oftentimes can have such a big impact, such a big negative impact on someone's stock market returns. And so I invest for dividends and cash flow. I want to go through 5 mistakes today. 5 investing mistakes. I have seen them pop up recently. These are mistakes that I'm seeing at the top of my news feed on a day-to-day basis. And I want to share these mistakes with all of you out there. So hopefully it educates the community and it helps investors out there avoid mistakes, avoid those horrible mistakes, those potential pitfalls that I see investors making all too often. This is going to be a really exciting video. Stock market is tanking a bit, and so I'm also going to discuss in the video what I'm doing about that. So let's get started with another dividend investing video. All right, so I want to jump right into it. Mistake number 1. It is this difference, this mentality of entitlement. It's this mentality of capital appreciation, total returns investing versus dividend investing. I can best summarize this mistake from a quote. This is a quote from someone I know. This popped up in my Facebook feed. It's actually someone who I really respect, someone I really like. And so I don't want to give too much information on who this is in case they're watching the video. But this was a quote that someone put on my Facebook. I saw it yesterday when the market was plummeting. And it goes like this. "Thanks, Trump. I'm not feeling very great today." And then it shows a screenshot, and it shows basically the Dow Jones Industrial Average plummeting. And so basically, this investor is basically coming at things, hey, it's a bad day. President Trump, it's your fault. The stock market is down. This is hurting me. This is bad for me. And what I am here to say is this mentality is the worst mistake. This is literally the worst mistake I am seeing investors make. And so there are so many layers to this mistake. But the first layer to this is just the fact that let's look at the numbers. Yeah, the market tanked yesterday. There's a lot of volatility in the stock market. But when I take a step back and I actually look at the numbers, the S&P 500 at its peak was around 3,025 points. That was the high. That was the peak. Now, as of today, the day after this horrible crash, we're at 2881. We are down, in other words, 4.8% from the peak. And so this person is saying, thanks, Trump, you've ruined my day. You've ruined things for me. Look, the market is down 4.8% from the high. It is taking the politics out of it. Look, I am not here to take one side or the other on the political debate, but what I do like to practice is just taking politics, taking emotion out of this and just looking at things factually. The market's only down 5%. And in another calculation I did, I looked when President Trump took over office and where the market is today. So January of 2017 versus today, and we're up, S&P 500 is up about 27%. And so, again, taking a step back, looking at the facts, it is not so bad. But basically, why is the stock market down? Why did it plummet yesterday? Well, Jay Powell, head of the Federal Reserve, he decided that they would cut interest rates by a quarter of a point. And in so cutting interest rates, there's been a lot of debate, a lot of discussion on what's really going on. I think part of the discussion is, hey, the economy is starting to slow, and so Federal Reserve's trying to get ahead of things, and so that's how they're looking at it. I think the other side of the debate is, hey, we have this trade war going on right now. In this trade war, it could be causing some issues with the economy, and so we're going to overcome some of those issues by cutting interest rates. And so I don't know what the real answer is. Personally, the way I look at it is we are in such late stages of this bull market. This bull market has come so long that the economy at some point, it's going to turn and we're going to hit a recession. I think the Federal Reserve is trying to prolong this bull run as long as they can, and they're trying to soften any kind of economic recession, and they're probably going to do this in anticipation of elections around the corner and trying just to bolster things. That's kind of how I look at it. The other way I look at it is the amount of debt, government debt, corporate debt, individual debt. It is so high that it is so insurmountable that in the foreseeable future, the Federal Reserve, it really doesn't have any choices other than to keep rates low and potentially lower them more. And so that is kind of how I look at things. But look, I don't wake up in the morning and be, hey, stock market's down, I'm going to blame someone for that. That is emotional investing. And this is what I want to talk about as well. People get emotional. People bring politics into it. And so that's kind of mistake number one. But the bigger mistake here is relying on capital appreciation. The very comment that this person made, and this is not, he's not, I don't think, a very big investor. This is probably a passive investor. This is someone who's probably an index fund investor. And that's a whole nother topic on its own right. But the reason he's making this comment, in my opinion, is this is someone that's closer to retirement age, and he relies on capital appreciation portfolio value to be able to retire. And so when he starts seeing this volatility, he's probably getting emotional, and he probably wants to find someone to blame, and it's kind of the blame game, and it's a sense of, also, I would say, entitlement. It's, hey, stock market's always gone up for recent history, so I expect it to continue going up. And it's this sense of entitlement around capital appreciation. And so my entire channel on YouTube here is to say there is another way. It does not have to be that way. You do not have to rely on capital appreciation, because relying on capital appreciation, having a sense of entitlement around capital appreciation, it is so incredibly risky. I am prepared for a market over the next 20 years where stocks go nowhere in terms of capital appreciation. And if that happens, I will be happy. I will love it. The reason being is I buy for dividends only. I invest in stocks. I pay dividends. The stocks I own tend to increase the dividends over time. As they increase the dividends, I have more cash flow coming in. I use the cash flow to pay bills. In my opinion, that is such a wonderful way to invest, because it takes the stress out of it. It takes the blame game out of it. It takes this reliance, this entitlement, if you will, around capital appreciation out of it, because so many common investors, they have been fooled by the media, and they've been fooled by the powers that be to go this passive investing route, to just pick these S&P 500 index funds and to go that route. And look, that route has its own merits. I don't want to dispel any investing strategy out there, because there are different strategies. I've found one that works for me, and that's what I'm sharing here, my journey. So there are other strategies, but a pitfall, there's pitfalls in my strategy, by the way, but I'm trying to share a mistake, a pitfall with that passive strategy is this reliance on capital appreciation, because I'm here to say it may not always be here. Like I said, I'm ready for no capital appreciation for the next 20 years, 30 years, 40 years. I don't care, because I'm literally investing for those dividend checks. And that is so peaceful. That is so freeing. It is such a wonderful concept, because I just don't have to worry, hey, what did Jay Powell do? Hey, what is going on with these trade wars? It just doesn't matter. All that matters is company performance and their ability to churn out more cash flow and pay me as a company owner. And so again, mistake number one, there are so many layers of this, but what I'm trying to share is, please do not have a sense of entitlement around capital appreciation. Challenge yourself if you are reliant on capital appreciation to retire or to pay your bills, and consider that there is another way of investing, a cash flow way of investing in dividends, where capital appreciation doesn't really matter, because the dividend checks are what pays the bills. The equity, it's nice, it's gravy. When it goes up, it makes us all feel good. It makes us have big egos, but it just doesn't matter when it comes down to paying bills, because it's all about the dividends. And quite frankly, the way I look at it is just so long-term and multi-generational as well, that I don't get caught up in the drama and the blame game. I can sleep better at night. I know right now, due to what's going on in the macroeconomy, there is so much unrest. So many people are scratching their heads. They're popping up in my Facebook feed, and they're playing this blame game. And again, they're doing that because they can't sleep at night, because they're uneasy with their strategy. And so personally, That's why I just love the dividend strategy. All right, mistake number 2. So this is one that came from my recent video. I just did a video on Pfizer. This is a stock I own, a pharmaceutical company. And I had explained, look, I'm realistic with myself. I bought Pfizer. I've done very well on it. I bought it after it dipped. But if I took a different route, let's say I bought Pfizer at the peak back in 2000 and I held it through now, 2019, I would be down in terms of capital appreciation. Quite frankly, this goes back to point number 1. Pfizer, over the last 19 years, it hasn't gone anywhere in terms of capital appreciation, but it's done just fine for dividend investors who are paying the bills with dividends. Anyways, the reason I'm bringing up Pfizer is I talked about the stock chart, and I talked about how the stock chart, hey, over the last 19 years, it's gone down, it's gone up, but when you look at all of it, it's gone nowhere, no capital appreciation. And someone popped up in the comments, and I don't want to put this person down because I love the comments, the subscribers, the community, but and again, I'm never picking on anyone, but I'm using this example because I know so many people look at it this way. And what this subscriber said is, hey, Ian, but did you look at all the stock splits? It doesn't matter that the stock chart has not gone anywhere because they've created so much value through stock splits. And so I want to point something out here. All right, I got my computer, by the way. Now, I have a bunch of notes in here, and so I want to share something. When you go to Yahoo Finance, which is a stock tool, a website that I use for my investing, if you read the fine print, it has a statement that says the close price is adjusted for splits. Meaning, if there are any stock splits that happen, the price, it's adjusted for splits. The chart is adjusted for splits. So in other words, splits are factored into the chart. Let me share this another way. This is really important. There are so many people making this mistake where they believe that a split creates value, that it's not reflected in the chart, that it creates some huge value. Literally, all a stock split does is it makes the share price lower so that investors can find it easier to buy shares when share prices get really high. But there is no value created through splits, none. A lot of people think these splits, they're magic, it's free money. I get rewarded for being a dividend investor or a long-term investor because I get these splits. Splits, splits, no value created. So let me show you this through math. If you take a 2-for-1 split, this is an example, the total value, your portfolio value in that stock, what does it equal? It equals the number of shares you own multiplied by the stock price. So let's look, before a split, hypothetically, let's say you own 1 share and the price is $100. What's your portfolio value for that position? Well, it's the number of shares, which is 1, multiplied by the share price, which is $100. 1 times 100 equals 100, so $100 portfolio value. Okay, what happens after a 2-for-1 split? Well, instead of having 1 share, you now have 2. You get 2 shares. But what happens simultaneously? The price per share gets cut in half. And so the price per share, it's no longer $100, it's now $50. Okay, what is 2 shares multiplied by $50? Well, 2 times 50 equals 100. So portfolio value, still $100. This is pre-split, post-split. And so what I want to illustrate here, again, mathematically speaking, is the split creates no value at all. Now, I guess the only value is if a company splits its stock, usually it's a sign of confidence. Usually it means the stock's gone up a lot, and they expect the stock to continue doing that. That's why they split the shares. Now, the risk with splitting is if stock price gets too low and then the price goes down, it looks like a cheap stock. It's embarrassing for the company. At a certain point, it could even get delisted from certain exchanges. And so splitting stock usually is a sign of confidence that management has in the company. Other than that, there's no value created. And so, again, when we go back to my Pfizer video and I look at the long-term chart, that is all adjusted for splits. It's all factored in there. And so when I say that the stock price literally has gone nowhere in 19 years, that is true. That is how Yahoo Finance interprets it, because they want you to have accurate data going back in time. And so if you're out there and you're looking at charts, you're trying to make decisions on charts, I think this is a huge mistake that people make. They're misinterpreting charts. Look, some people look at Pfizer, 19-year history, and they're like, hey, yeah, I understand the stock chart hasn't gone anywhere, but I'm going to buy it anyways because I know they've created value through the splits. if you're looking at it that way, that's a huge mistake. The way I look at it is, look, Pfizer, yeah, it hasn't gone anywhere in 19 years, and that's true, but I bought it when it was way down, deep discount, and I'll continue to do that in the future. And I'm going to go in this thing eyes wide open. Pharma's risky, stuff can happen. Long-term capital appreciation, maybe it'll be there, maybe it won't. But if I buy smart, if I buy when it's cheap, I can do really well, like I already have, because I bought it at deep discount. And so these are two different ways of looking at it. And what I'm trying to illustrate here is look at the data correctly. It's okay if it hasn't gone anywhere in 19 years because you can buy for cheap. You can buy it when it's on sale. And it's also a function of just that industry being risky. Okay, so while I'm on the topic of charts, there's another mistake sometimes that people make with charts, and this is with spinoffs. And so one illustration that I want to bring up is Altria, ticker MO. I own this one. I actually looked at the chart and it doesn't look this way anymore. But when I'm analyzing long-term charts, I like to look at charts. They help me make decisions. And so Altria back in the day, if you looked at it, it was trading up here and then all of a sudden it tanks and it's trading down here. And so some people, when they look at that chart, they might just assume, hey, it fell off a cliff because they had a bad quarter, stock sucks, it's no good. But if you actually look at the data, the reason Altria was trading up here, then it went down here, is because they split into two. They split into Altria and Philip Morris, the international arm. And so sometimes when you're looking at charts, if you see a sharp cliff, don't always assume that, hey, they just had a bad quarter, stock's no good, it's trading really bad. Look into the data further and try to understand, well, what really happened at that moment in time? Was there a spin-off? Because then you're totally underestimating the value of the company. I think a lot of people do this with a company like Altria because they don't factor in the value of these spin-offs when they're doing their stock market analysis. And so if I'm looking at a stock chart and I see a stock fall off a cliff, I always go to that point in time to understand really what was going on, because it's not always a bad thing that it fell off a cliff. There could have been a spin-off. And so this is really timely because I know a lot of investors here on PPCE, and we're buy and hold forever. We're looking for the long term. We're looking for the dividends, and we're looking at historical data. We're looking at long periods of historical data. We're looking at charts. And the takeaway here is not to make the wrong assumptions, not to make the wrong interpretations around splits or just around spin-offs. And so it's so important to be careful with the data. All right, so mistake number 3 is basically spin-offs and dividend cuts. This is related to the Pfizer example as well. And so the point I want to hammer home here is math. It really matters. Accuracy matters. Logic and analysis matters. And so there's another comment or two on this channel saying, look, I own Pfizer. I like it. I'm not buying yet, but maybe I'll buy it if it tanks more. And they're saying, hey, Pfizer, it's not a good stock here because they're going to cut the dividend. Why are they going to cut the dividend? Because they're spinning off Upjohn. It's going to merge with Mylan for the generics business. And they're saying, if they do that, they may cut the dividend. Pfizer, it's over. Dividend cut. Why would I want to own a dividend cut company? So the logic behind that, and look, I'm not trying to put anyone down. These are real-time discussions. Everyone is putting their best foot forward. I love everyone in the community. This is dividend investing for everyone. I'm just being honest here because I want to up-level the whole community. We are dividend investing for everyone. I want everyone to be equipped in the community with the knowledge that I know and with my personal journey. And so I want to look at this for a minute. Okay, so Pfizer, in 2018, their total revenue was $53.6 billion. And with this whole Upjohn thing, the revenue is expected for the Upjohn Mylan spinoff to be $20 billion. And Pfizer is going to own 57% of the Upjohn Mylan spinoff, Pfizer shareholders. Okay, so if I take 57% of 20 billion, which is the expected revenue of the new company, what does that come out to? 11.4 billion. That is kind of the Pfizer component to the spinoff, what Pfizer shareholders will get. Okay, I'm assuming then that means that Pfizer is going to probably lose that amount of revenue. That amount of revenue is shifting from Pfizer over to Mylan Upjohn. Okay, so we have 11 billion, 11.4. What is 11.4 billion of 53.6 billion? Remember, 53.6 is total revenue of Pfizer. But this new spinoff with Mylan, the Pfizer component of it is accounting for roughly 11.4 billion. 11.4 billion divided by 53.6 billion is about 21%. So what am I saying here? Basically, in terms of revenue sales, Pfizer's taking 21% of their company. And instead of it being part of Pfizer, it's going to now be part of Mylan Upjohn. And this Mylan Upjohn spinoff, Pfizer shareholders are all going to get shares in it. They're going to own 57% of that total company. And so what's really happening here when you look at the analysis, you look at the numbers, is revenue is shifting. They're shifting the business. They're splitting off part of the business. And it's not just going to split off and current Pfizer shareholders get nothing. It's splitting off, and current Pfizer shareholders are getting about 57% of that combined entity. That's going to have about 20 billion in sales, and the 57% of that 20 billion is the 11.4 billion. So here's the deal. Core Pfizer, I don't know if they're going to cut the dividend or not, but people are out there saying, hey, they're going to cut the dividend 20%. Okay, let's say that's true. Even if Pfizer cuts the dividend by 20%, that's not a reflection of poor performance. That's not a reflection of fundamentals. It's literally a reflection that they literally took 20% of the business and it's now part of another company. And that other company, that 20%, I still have a stake in it because I'm going to own shares in that combined company. And that combined company, maybe it'll pick up the 20% dividends that were lost at Pfizer. I'll pick them up there and it'll come from the new company. And so when someone says, hey, Pfizer's not going anywhere, it's not going to do well, they're going to cut the dividend because of this spinoff, they're partially right. They're right on the part that maybe Pfizer will cut the dividend. I don't know if they do or they don't, but they're wrong on the part that Pfizer's a bad investment because of it, or Pfizer's a bad company. They're literally shifting revenue. They're just shifting business over, and I'm going to own part of the new business as well, and I'll pick up whatever dividends were lost here, I pick them up over here. And so this is why when you're analyzing dividend stocks at home, you want to take the time to really think about what's happening, the full ramification, the full cycle, because it's not just about, oh, let's look at Pfizer in isolation. It's let's look at the whole picture. Let's really understand what's going on here. It's a shift of revenue. And so I see people making this mistake, and I think they're getting this negative sentiment around Pfizer because of this spinoff, whereas you're not, even if they cut the dividend, likely it's going to be picked up over here. And so it's just restructuring. Now, do I like the restructuring? Am I a fan of it? I have mixed emotions. You probably saw that in my last video. I'm going to employ a wait and see on the new company. I'll see what happens. Maybe I'll sell it, redeploy the money. Maybe I'll just hold it forever. But I love my core Pfizer, especially after doing my balance sheet analysis, and I see how strong their balance sheet is. It is fabulous. And so, as compared to their peers. And anyways, again, I'm not trying to put down anyone. I'm not trying to put down comments. I love your comments, but I'm trying to add clarity to the community here so that everyone is looking a few steps down the chain when it comes to topics like this. So that's another recent mistake I'm seeing. So I want to bring up another one. This is inaction due to this doomsday mentality. And so there are a lot of people, not a lot, but some commenting, and I get this all the time. Ian, I like what you're saying. I like this idea of dividend stocks, but the problem is I only see bad stuff. I see bad stuff in the future, and I see bad stuff for the economy, for inflation, for deflation, for this or for that. There's 100 reasons, and these people say because of that uncertainty, that bad stuff that could be coming, most of it is, hey, I'm worried about the national debt, and I'm worried it's going to catch up, and no matter what I do in the stock market, in the future, at some point, everything's just gonna go away. And so there's these people that are fearful, and they live in fear of the future, of the unknown. And I understand where they're coming from because I'm a fundamental investor, and I agree the fundamentals of the economy, they're kind of wacky. The national debt, it's wacky. These interest rates cuts are wacky. The trade war is wacky. There's a lot of things going on, quite frankly, that give me concern. They give me concern as a fundamental stock market analyst. I would like to see things at a government level handled very differently, not only in the US, but globally. I'm a more conservative financial person, and I'd like to see the governments be a little more conservative with how they're running these countries. That being said, I always just focus on progress forward. And I'll tell you why this doomsday mentality, it is so plaguing. It is such a pitfall. It's such a mistake for investors, because I'll tell you, there's going to be one or two things happen in the future. One, things are going to more or less be the same as they are now. And when I say more or less, maybe stock market goes nowhere for 20 years. These S&P index investors are probably going to really dislike that. Dividend investors like myself will love this because it gets me more starting yield, gets me to my financial freedom quicker. But more or less, things be normal. There'll still be a stock market. We'll still have the government, we'll still have the US dollar, we'll still get our dividends. These dividend companies, they'll still pay a dividend. Many of them will continue to increase the dividend. So that's school of thought one. If that happens, hey, everything's good. Everyone here in the community, everything's real good. But then there's school of thought two. What else could happen? Okay, hey, governments here got into really hot water. It's gone. Everything's just like, bam, the system's gone. Massive inflation or something crazy. Companies can't operate anymore. Okay, game over. And so these are kind of two possible scenarios. And obviously scenario one has a spectrum of what could happen. So does scenario two. But what these doomsday people say is they're like, hey, Ian, I hear what you're saying about dividend stocks, but I don't really want to do anything because I'm just concerned of this second scenario. Okay, so this is how I look at it. I love this mistake. I love talking about this mistake because it is so fundamental to life, not only to investing, but to life. Let's just say scenario two is going to happen. This doomsday thing. You can prepare and do this and that to get ready for something like that, but ultimately if that happens, no matter what's going on, it's going to be just so bad. It's going to be a really bad situation. And so the question becomes, if I'm different about my money right now, if I'm different with how I live my life, is it really going to matter? Probably not. I mean, I guess maybe I could really live it up now, like my man Ja Rule, and I could just live it up and not invest in dividends and go out to Louis Vuitton and buy all this stuff, buy a Bentley, whatever, and go crazy. And so maybe that could be a strategy if we're going to have doomsday, because at the end it's all going away anyways. So that's kind of the only thing I could do different. But the way I would look at it, quite frankly, is I'm not losing anything by being frugal. In fact, by being wise about my money, by being frugal, I think my quality of life, it's just as good as if I was living it up really big time like Ja Rule. And so that's kind of the way I look at it, is no matter what happens in the future, I'm not going to change what I'm doing because my quality of life, it's not going to change one way or the other. I'm just going to live my best life, and living a frugal life versus the living it up life, it's not going to change anything. I'd actually argue that the frugal life, being calculated about things, perhaps it leads to a better quality of life. And so because I'm not going to operate any differently no matter what happens in the future, I am forced just to live my best life now, to assume and to live as if things more or less will be okay going forward. And that brings me back into bucket one. And bucket one is I can't be scared. I got to put my best foot forward. I got to focus each and every day how I can live my best life, how I can set myself and my family up for a nice future, for the best possible future financially through dividend stocks. I just got to operate that way. And so people who are so scared of investing because of this potential catastrophe that's going to happen with the national debt, I challenge you to go home, take a piece of paper and literally write out what are the scenarios. Do a tree. Do a whole tree diagram. What could happen in this case, this case, this case. When I've done this, what it always takes me back to is, look, no matter what's going to happen in the future, I don't know. I can do my best to prepare. But what really matters is living my best today and assuming that things more or less are going to be operating normally in the future. And so I see a lot of people getting persuaded out of the stock market completely, out of their future, their financial future completely, and just holding money in cash because they're plagued by what's going to come. Now, I will tell you, look, markets at all-time highs. There's this concept of dollar cost averaging. Certainly, if I was sitting on a pile of cash, personally speaking, I'm not the kind of person that would just put it all in at once. I like to dollar cost average, deploy it in slowly over time. And certainly I think that would be a prudent thing to do given where the stock market is right now. And so I don't want to get that concept confused, but what I'm just trying to say philosophically is these doomsday people who are concerned about the future, this is how I look at it, and this is how I get past that kind of stuff. Because look, there's no way to operate other than just to assume that things more or less will be stable. There will be more or less a similar system in the future to now. Because if there isn't, it doesn't really change what I'm doing now anyways. So great mistake. I love this topic. So moving on to the fifth and final mistake, and then I'm going to get into a bonus one on what I'm doing right now with my money in dividend stocks. So number 6 is, number 5, this one, I hope I'm not creating a big riff here in the dividend community on Facebook, YouTube, all these channels. Look, I already brought this up on my Facebook group. I'll link in the description below. If you want to join my Facebook group, we have a thriving community there as well. I already brought this up. I had to do it there. People responded well, so I'm gonna bring it up here, but I hope this isn't setting something off. But we'll see. Look, and at the end of the day, I love everyone out there in the dividend community. But this is a mistake. These, and I don't want to put down any platform either, but the mistake I see people making is they feel they have to go with a certain platform. And a lot of these platforms that they're going with, I'm talking about brokers. You don't see me here pushing one broker over the other. And I do that very purposely. And I see in the internet, in cyberspace, there are different people in the dividend community and the investing community that are real strong. They're real heavy-handed, and they're like, this platform or the highway. And they even say stuff like, I'm getting rich because of this platform. I'm making all these dividends because I'm on this platform. And they'll even entice people with these affiliate links, and they'll say, hey, sign up for this platform and we'll each get a free share of stock. Well, what's funny is that free share of stock, it's usually going to be, or oftentimes going to be in a company that's trading so low, it's like, oh, great, I just got $5 for free. Great. And so the pitfall I see people making, the mistake I see people making, is they're feeling compelled because of the content out there, because a lot of this content is charged. It's charged with people getting affiliate commissions. And I don't want to put people down because there's certain people doing this right. There's certain people doing it right. Affiliate links do have their time and place. I reserve the right at some point in the future. Here, maybe I'll have a choice affiliate link or two. But right now, as it pertains to financial platforms, I don't do affiliate links on this channel. And I don't do it for a reason. Very specific. Again, I don't think that one platform over the other, it matters all too much. In fact, I like the bigger platforms. I like the ones with a brand name. I like the ones that have been around a long time. I like paying commissions, small commissions, but I like paying commissions because I'm getting into a platform that has history, stability, it's robust. And here's the deal. I think a lot of people going towards these free platforms, they're enticed by the hype. They're enticed because people are charged with affiliate links, but they're also thinking too short term. And so what I'm trying to say is to live off of dividends, it really, in my opinion, requires a pretty large portfolio. I did a video a while ago, I'll link in the description, how I'm building a multi-million dollar dividend stock portfolio. That's what I'm doing because I want to live in the Bay Area. It's expensive, so I need a big portfolio, and I look at that as a challenge. But even if you're not like me, you want to live overseas, you want to maybe do geo arbitrage, live in Thailand, for example, you probably will still need a dividend portfolio somewhere in the hundreds of thousands. So we're talking big money. And so personally speaking, if I were using like a free platform kind of thing, maybe I would trust that with 25 grand, 50 grand, 100 grand, maybe even 200 grand. But I'm saying once the portfolio's up there, 300 grand, 500 grand or more, I personally just wouldn't feel comfortable with some of these platforms. And so I think a lot of investors, they're getting into these platforms because they're thinking about the short term. They're like, well, I'm starting with 1 grand or I'm starting with 5 grand. But what I'm trying to say is, don't make this mistake necessarily. Think through what you're doing. Because if you're in this community here on PPC Ian, I want to challenge people here. I want to challenge you to think bigger. Are you really trying to create a $50,000 portfolio, or are you going to create a several $100,000 portfolio? Are you really creating a $25,000 portfolio? Are you going to be in the millions? I want this community to be about millionaires. I want this community to be about people with huge portfolios. And so when you think about the long term, and this may seem impossible, this may seem difficult to you right now, but it all comes down to the power of compounding. We've talked about this on the channel before. I've shared Excel models for free, my best content for free on this channel, no affiliate links behind it. And I'll link to it in the description. I want to challenge people to think bigger with your life. And so yeah, in the short run, maybe it's nice to get a free $5 stock or $50 stock or something, or even $200 stock. But when you are looking 20 years out, 30, 40, maybe you're looking generationally, maybe you're looking at your kids or even their kids, and you're llooking at millions and millions of dollars. Do you really care about that free stock or that free $50 or this or that? And so I'm not trying to put down a platform, because I love some of these platforms too, because they get people investing who would have never invested otherwise. And more people investing is a good thing. I love how people all around the world are taking command of their personal finances. It's awesome. But at the same time, it's a mistake in some cases that I think people have tunnel vision, and they are just going by the affiliate hype. They're going by what one person on the internet says, or a few people, but realize there is a different way. Look, you can buy stock directly from a company through a transfer agent and bypass the broker channel altogether. And so there are other ways to do things. And so what I'm saying is challenge yourself. Don't make this mistake of thinking short term. Think about the long term, and think about what this dividend portfolio, this stock portfolio means to your family in 20 years, in 50 years, in 100 years, in 200 years. And so that is how I like to look at things. Hey, maybe you're different. Maybe you're looking at it differently. Again, there are many ways to do things. I love everyone out there. I love all the platforms, but I have to point this out because I think the conversation on the internet, it is going so one-directional in this respect. And I believe I'm probably starting something off here. I'm setting something off. I know some people are going to be upset, but I guess what I'm saying is I got nothing but love for you, like Heavy D. And many people on the internet are doing it right. They're using affiliate links, but they're doing it in a very calculated and thoughtful manner. But there are some people that are not. And so I just had to surface this. I just had to do it because it keeps me up at night, actually. It actually keeps me up at night because this hype. I think the dividend community is becoming the acai berry of the future. I literally think the affiliate commissions are so high on these platforms. They are so lucrative for people online who are promoting these platforms that it is skewing the discussion, and the discussion has to be more even. And so that's that. Now, I will put the disclaimer out there that I do earn revenue here from what I do online, and my revenue comes through advertisements, so advertising, and it also comes through the eventual sale of a book that I'm working on. So I want to add that disclaimer as well. But as of now, as it pertains to financial platforms, I don't have affiliate links online. I do have some affiliate links online as it pertains to other products, especially around personal journaling and reading, about a book product, reading and knowledge. And so that's something I have shared in the past, where I did include some choice affiliate links because it made sense, but not around these financial platforms. All right, so you've been waiting. You want to know, what am I doing in my portfolio? So I'm always buying. Stock market's going up, stock market's going down, I'm buying. It just so happens that this most recent drop, it created an opportunity again in a stock that is very strategic for me this year in 2019, 3M. And so that's why I've got the Scotch tape. I got the Scotch tape up here. I love 3M, ticker MMM. I've been buying the stock this year, and it came down again. So I bought some today at $163.09. And what's really cool about that is if I take their dividend, annualized, $5.76, I divide by the share price that I got, my starting yield is a sweet 3.5%, which is actually pretty high for 3M. If I take the share price I got, I divide by consensus estimates this year of 941, I get a forward PE for 2019 of 17.33. So not bad, not a bad yield for 3M. Now, I was thinking I probably wouldn't be able to get more 3M, but it just so happens that this gift, it appeared, and this is why I love being a dividend investor. This is why, quite frankly, the sense of entitlement, capital appreciation, it's such a pitfall, because when you go from that bucket to the dividend bucket, you start looking forward to these things. You start thinking, President Trump, you shouldn't have done that for the trade war, to thinking, hey, thank you, this trade war is awesome. I'm getting 3M at a discount, and I'm only buying it for the dividends and the growing dividends that I'll use to pay my bills, my food bills, my energy bills, my whatever it happens to be, kids' education bills, all clothing, all kinds of stuff. And so that's what's so cool about dividend investing. But that's what I'm doing. And yeah, stock market's only off about 5% from the peak, the S&P. So hopefully it'll go down more and more opportunities will present themselves. So I'm glad I picked up more 3M. That's a strategic stock for me this year. Hey everyone, thank you. Please subscribe to my channel if you enjoyed the video today. Best way you can thank me, click that subscribe button and the little notification bell next to it. Before I leave today, in terms of a full disclosure, I own the stocks mentioned today. I own long Apple, ticker symbol AAPL, 3M, ticker symbol MMM. I am long Pfizer, ticker symbol PFE, and I think that's it. I think those are the ones I discussed today. Also, I always have the disclosures in the description below as well. In terms of a friendly disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult a licensed financial advisor first. Literally just sharing my journey here on YouTube for fun and entertainment. And again, additional disclaimers in the description below. Everyone, again, please subscribe. I love the questions, comments, feedback as well. Thriving community here. We are growing so quickly. Dividend investing for everyone. Everyone is welcome here. I love you all. I will see you in the next video.